Hey guys, welcome to the video on the economy, and we're going to be talking about today fiscal and monetary policy. So yesterday you should have watched the video in Ed Puzzle on Intro to the Economy. What is economics? Today we're going to be taking a look at how our government, especially in a time like this with the pandemic, is going to be dealing with the economy. And there are two types of policy that we're going to take a look at, fiscal and monetary. So as we go through the video here, you do have a note sheet that is linked in Google Classroom. You should be using this video to fill in those notes on Google Classroom. So the first thing that I want to talk with you guys about is our typical capitalistic economy. We are a capitalist country. The individual owns their own factors of production, right? We're not communist. The government doesn't control that stuff. And this is the typical shape of our economy here. So as you notice, it's kind of like a wavelength kind of looking thing. So our economy naturally goes through periods of growth and periods of downturn. Okay. When the economy is improving, we say it's in recovery or a boom. And when the economy is declining, we say it's in a slump or a recession or a depression, depending on how bad it is. And hopefully you've heard some of those words before as well. Now, one of the issues when we get down into the declining stages of things would be unemployment, high unemployment. And we'll talk about that as we move through this presentation. And then one of the other issues when we get to the top of the economic cycle here, the business cycle, where we're having a boom, is inflation. And again, we'll talk about what inflation is, but it is a sign that the economy is really, really, really good, almost too good. Things are growing too quickly. So our question is, how does the government influence the economy? Well, it does three big things. It first promotes employment, and it will do that when we are in a bust or a recession, right? We're in a slump. When the economy is not doing well, the government will try and promote employment. It will promote production. Again, this is typically done when we are in a recession, when the economy is not doing well. And then it also fights inflation, or a short way to look at this is rising prices. And this, the government will take action when we are in a boom, when the economy is growing, and especially growing too rapidly. So we're going to break these down here very quickly. So promoting employment. The very first thing that economists and even political officials will look at is our unemployment rate in our country. Americans love our jobs, right? We want to make sure that the government provides those jobs for us. So a sign of a healthy economy is a low unemployment rate, or the percentage of people who are unemployed and are looking for a job. Before COVID-19 and this pandemic, the unemployment rate was around 4%, which is about as good as you can get it, because think about it, right? Not everyone's going to have a job all the time. You're always going to have people unemployed and looking for work. So to keep that 4% in perspective, during the Great Depression, our unemployment rate was like 25%. Right? And obviously our economy was not doing very well. So the government will promote employment to get this unemployment number down as low as it can go. And as I've mentioned, Americans really expect that our government helps create jobs. So think back to the Great Depression and what you talked about in American history class, right? FDR, what did he do to promote employment? He got people to work. He created works programs, infrastructure. People were building roads and dams and buildings. There were work programs that the government funded that tried to lower the unemployment rate in our country and try to get people back out there so that they could put their money into the economy. Now, the government also promotes production, as I mentioned, when we are in an economic slump or a recession, because think about it, right? If people aren't working, they don't have enough money to purchase goods. If people are not buying goods, companies are going to stop making goods. So there's this cycle of economic depression almost. So the government wants to promote production, and we measure our production through not unemployment this time, but GDP, gross domestic product. And these are the goods and services that we produce in a year. And this is anything from a haircut that you pay for, to your groceries, to the creation of an automobile. Those get factored into the gross domestic product. And the more goods and services that we have, the more wealthy our country is considered to be. And the government can do things to increase or decrease production depending on the needs of the country at the time. Most of the time wanting to increase production to boost the economy when it's down. Right? And then the third thing that the government plays a role in the economy is fighting inflation. And inflation is when the cost of something increases, but the value of it does not. And this typically occurs during periods of very, very high economic growth. Okay, so I want you to think about an example. Let's go back to 1966. Gas cost around $32 or 32 cents a gallon, and you could buy a new house for $23,000. That sounds pretty good to me, right? Those are pretty cheap prices. Now, just a few years ago in 2016, gas cost $2.46 a gallon, and that same house that would have cost you $23,000 in 1966 would have cost you about $313,000. So this is inflation, right? Guys, gas hasn't changed. It's still the same thing that runs your car. It's still the same house as before. But ultimately, it's the rise in price. Okay, it's the increase in price. And the government wants to protect against this high cost of goods. Okay, so we have to think about what strategies will the government use when we are in our places in the business cycle. Okay, so the very, very first one is expansionary strategies. Okay, the goal of expansionary strategies are to create growth and to stimulate the economy. Okay, these are going to be used during economic downturns. So when we're on the downward slope here, in a recession, a depression, to basically pump money into the economy, right? If you're in an economic downturn, you want to do things that will encourage people to borrow and spend. Okay. Now, contractionary policy, on the other hand, is used to slow down or to restrict economic growth. And I know that sounds kind of weird, right? Why would you want to slow things down if things are doing well? So this is used during booms to restrict the amount of money in the economy. And the reason for this is, and I like to use this example when I'm talking with you guys about this, right? You've probably seen at some point like a little kid that is learning to walk or run for the first time. Right? They get going, they get running, and they fall over because their feet are unable to keep up with them as they're learning how to walk and run. Our economy can do something very similar. Our economy can grow way too fast to the point where it trips over itself and grows too quickly. So contractionary policy is used to prevent that basically crash from happening. And doing so will restrict the amount of money in the economy. You're going to discourage people from spending and actually doing things to improve the economy. Okay, so expansionary policy, expanding the amount of money, creating growth during times of downturn. Contractionary policy, you're going to slow down or restrict growth when things are growing too quickly. Okay, so there are two types of economic policy. The very first is fiscal policy that we're going to be talking about. And fiscal policy is policy used by Congress and the president, so the government. They're going to be responsible for fiscal policy. And this is how the federal government will influence the economy by spending, taxing, and borrowing. Okay? The Congress and president are responsible for deciding the budget in terms of what gets spent where, how much people are taxed, and how much money we borrow from other countries. So in action, during a depression, fiscal policy would look something like this. The government will spend more and collect less to encourage economic activity. And this is an example of expansionary policy, right? Because we're in a depression, we want to make sure that there is more money being pumped into the economy. We're going to spend more to put that out there, create jobs even, and collect less in taxes to encourage activity. So, depression, spend more on jobs, lower taxes, right? Because if you are taxed less, you will have more money in your paycheck that you can then go out and spend in the economy. Okay. Now, during a boom where there is high inflation, the government is going to do the opposite. They're going to slow spending and they will collect more in taxes to slow growth. So that's going to be an example of contractionary policy, right? Because if you are being taxed more, you never see that money in your paycheck. So you have less money to actually spend in the economy, and therefore you slow it down. You don't have as much to invest or spend. Okay. So I know, guys, that this seems kind of confusing, but in another way, if you just think about it like this, if we are in a bad economy, increase spending and borrowing, decrease taxes. Economy is good or too good, they will decrease spending and borrowing and increase taxes. So for all of my visual people down here or around here, this is what it looks like on the fiscal policy expansionary and contractionary side, right? So you can see it's kind of an opposite game here. When we're trying to expand the economy during a time of downturn, government spending goes up, taxes go down. When there is contractionary policy, then during times of booms to slow it down, government spending decreases. There's going to be a tighter, restraint on our money, and they're going to increase taxes, make us give more, in taxes, so that we spend less in the economy. This is actually a great example. Right now during the pandemic, I would say we're probably right now in some expansionary fiscal policy. Just last week, Congress and the president passed a stimulus bill that's going to send money back to the American people to spend into the economy, right? The whole point is to prevent our economy, which has been ultimately halted, from going into a free fall. So they're going to give us money back to take it and spend it to stimulate growth. Right? Now, on the flip side, if we were growing too much, we definitely would not get a stimulus bill like that. In fact, taxes would probably increase. Okay. The second type of policy in economics is monetary policy. And this isn't done by Congress or the president. Instead, it's done by the Federal Reserve or the Fed. And this is the Fed's control of the money supply or the amount of money in circulation. So you can think of it like monetary money. Okay. Their main goal is to fight inflation, right? They want to make sure that rise in prices stays pretty stable and make sure that things are in control that way. Okay. So whereas fiscal policy was spending, taxing, and borrowing by the government, the Federal Reserve or monetary policy is going to fight inflation. And this Federal Reserve was created in 1913 to serve as the banker's bank, quote unquote. Banks have to get money from somewhere, so they're going to get it from the Federal Reserve. And the Fed is really in charge of two things. The first would be the amount of money that banks have to lend out. They're going to control that amount of money, and this is called the reserve requirement. The amount of money that banks are required to keep on reserve at all times. Okay, and by lowering and raising that, as we'll see in a second, the Fed can adjust how much money is in circulation. The Fed will also set interest rates, and interest is a fee for borrowing money. So think about this way, right? When you go to buy a house, not many people are going to be able to just pay for it with cash, right? Those are pretty big investments, and most of us will have to take out something called a mortgage, and that's a loan from the bank for a house. Now, when you take out that mortgage, you owe the bank back that amount of money plus interest, which is a percentage of the amount you took that you will have to pay back. So ultimately, high interest rates discourage borrowing money, and low interest rates encourage borrowing money, right? You're going to be much more likely to take out a loan when you only have to pay back your loan plus 4% than your loan plus 18%, right? So by either raising or lowering interest rates, the Fed can use either expansionary or contractionary policy that way. So again, looking at some examples here in action, during a depression, when the economy is low, the Fed's main goal is to increase the amount of money in circulation to encourage spending. So again, that is expansionary policy. So they will lower interest rates, right? People have to pay back less in interest when they take out a loan, and they're going to lower the reserve requirement. So let's say that a bank is typically required to keep $10,000 on reserve. Okay. If the Fed says to lower that reserve requirement, the bank now only has to keep in, let's say, $8,000. That's $2,000 more that the bank can lend out and put money out there into the economy. Okay, so during a boom, then, when there is inflation and things are going really well, almost too well, the Fed's going to be trying to decrease the amount of money in circulation to discourage spending. And this is contractionary policy. So here, they will raise interest rates, right? Hike those up so that borrowers have to pay back their loan plus even more money, which is going to discourage borrowing. And they will raise that reserve requirement, telling banks you actually have to keep more on reserve at all times. You cannot loan out as much money as you did before. And that is going to restrict the amount of money in circulation, the amount of physical money that is out there for people to use. Okay. So hopefully this was straightforward. If you have any questions, please make sure to write them down on your note sheet. Please answer the summary question where you are talking about the differences between fiscal and monetary policy. And what I have added on here are 2 crash course videos if you would like to view those for additional guidance. I have one on fiscal policy, as I said, and monetary policy. Those will be here for you to use at your leisure. Now, the next activity that you're going to do is thinking about these concepts that we just talked about in these notes. You're going to head to Google Classroom and complete the article review that I have posted there about the economy today and how the pandemic of COVID-19 is affecting our economy. Okay, so make sure you guys ask questions, come see me during office hours, and I will talk to you guys soon. Bye.